So good evening, ladies and gentlemen. We'll start the session now. And before we start the session, let me just do a small introduction about myself. My name is Chandana Sir, and this is my 24th year of lecturing for financial reporting. And over 24 years, I have produced 23 prize winners on the subject on Lynch Chartered Accountancy. So for the moment, I am lecturing for Chartered SL1, CL2, SL2, and also for ACCA SBR and for ICAW corporate reporting. So without just blowing my own trumpet too much, we'll come to the point. And today we will be discussing some important areas which I think are highly examinable. And before I start the session, let me extend my heartfelt gratitude for Infinity for organizing the session, and also for Big Four Facebook page for trusting us and supporting us. Okay. Now we know in CL2 paper there are 7 questions. The first question is MCQs, and there are 10 MCQs. Then key areas of the paper are ethics, consolidation, SLFRS for SME, ratios, and apart from all these, at least every other exam we can expect a question from financial instrument, revenue, and leases. So with this time constraint, I don't think I can explain the entire syllabus. That's not possible at all. So I have picked some past paper questions from CL2 and also from other exams to discuss some 3 important accounting standards. Till I don't think I will be able to complete the entire accounting standard today, but my effort is just to give some relief and to ease you from this financial reporting chaos. I feel that will be of a great help at the exam with this discussion. Okay. I think the paper would have been shared. I'm sorry, I have a bit of a cough and you will be disturbed. I have taken couple of questions, partly from CL2 and partly from some other exams. And let me start it with some easy question. Easy question. So there is a question saying question number 3, and that is a past paper question of CL2, and that has been given from SLFRS 9. It is from classification of financial assets, and if you want me to explain little about classification of financial assets, we will do it first and then we can come back to the questions. I wish I can have a small response from you all. Just let me know whether you want me to do a small introduction on how financial assets are classified, and then we can come back to the questions without we start discussing the question all of a sudden. Please, can somebody give me a small feedback what you want me to do, whether you want me to do a small introduction of financial instrument classification before we come to the question. Yes or no? Ahmad is there, Sajid is there, Gayan is there, Madhushani, Abdullah, and there are some other students joining live. Yes? Hurry up. Yes or no? Okay, anyway, we'll do a small introduction. Since this is about financial assets, let me only talk about financial assets for the moment. And if you want me to explain financial liabilities as well, so I don't mind explaining financial liabilities also. Right. Now SLFRS 9 introduces 3 financial assets in their classification. SLFRS 9 introduces 3 financial assets, 3 kind of financial assets. What are these 3 kinds? Fair value through profit and loss, fair value through OCI, and measured at amortized cost. Now also please remember, in the entire world, starting from the northern pole to the southern pole, trust me hand on my heart, there are only 3 financial assets in the world. Now we have different people in the world, but we have only 2 types, men and women. But on different criteria, it can be sex, it can be religion, it can be the color of the skin. Based on different criteria, the people have different distinctions and segregations. Likewise, in the entire world, when His Almighty created the world, He has created only just 3 financial assets. So that's what we are trying to classify into 3, which SLFRS 9 introduces. So what are the 3 financial assets in the world? Derivatives and equity investments. Equity investment. Equity investments and debt investments. You heard me right, there are only 3 types, 3 assets, financial instruments in the world. It can be either derivative, or it can be equity investments, or it can be debt investments. And you all should know whether derivatives should come under fair value through profit and loss, fair value through OCI, or measured at amortized cost. Or you should know whether equity instruments should come under fair value through profit and loss, or fair value through OCI, or measured at amortized cost. Then again you should know whether debt investments need to come under which of these 3 categories. So that's what we are going to do. So ladies and gentlemen, remember, for us to facilitate this classification, SLFRS 9 introduces only just 2 criteria. Only 2 criteria. Business model, contractual cash flows. Contractual cash flows. You need to make use of these 2 criteria to decide how derivatives are classified. You need to use these 2 criteria to decide how equity investments are classified. And you need to use these 2 criteria to decide how and where the debt investments will be classified. So what do you mean by business model, and what do you mean by contractual cash flows? And let me share a small story to explain the business model. Very simple concept, not hard at all. What is the story? Now, say Saman Mali, she is now going to get the entrance to the university, and she has to take the enrollment by tomorrow, and the parents are now advising to the daughter, darling, better to fully focus on your studies, please don't be distracted, better not to have crushes, we will find you the perfect partner. And mother says, mom says, even I am from the same university, I had so many crushes, nothing worked, really nothing worked at absolutely nothing. So if you can focus, if you can stay focused on your studies without being distracted, we will give you an exciting gift. What is it? Already we have purchased two properties, property A and property B. One is behind CS Sri Lanka, the other one is in front of CS Sri Lanka. And property A, this is 500 million, this is also 500 million. And this is what you will get, then this is where you are going to dwell and live with your husband in the future. So we will just keep it rented for the moment and we will make some rental income. But this property will be sold just few days ahead of your wedding. So whatever we can collect from the sale of property B will be gifted to you, then that is your gift from us. Okay. So this is to generate rental income and this is for sale in the future. Now, how does this property generate a cash flow to the business? Through the rental income. How does the second property generate a cash flow to the business? And that is from a sale transaction. So the Samanmal is that every day morning, as he sits for the breakfast, he becomes little nagging and whining, and he always keeps asking the market price of which property. Not property A but property B. Why? That property is the property that will generate a cash flow from a sale transaction. And Samanmali's dad is not so interested in knowing the market value of property A because that does not generate a cash flow through a sale transaction. So that was really annoying. Every day, Samanmali's mom has to give the market price. So she keeps the market value of property B once in a week and she keeps it hung in front of where Samanmali's dad used to sit so that he can see it prominent and need not to ask it from anyone else. So the same thing happened in a business. What do you mean by the business model? The business model of property A is what? Rental income. Business model of property B is what? Sales proceeds. You need to decide how all of these assets are presented in the balance sheet in a way the business model is demonstrated. You need to show all the assets of a business in a way that the business model will be presented, business model will be reflected on the balance sheet. So that is why you decide to show this property at fair value. That is the business model. You decide the subsequent measurement of the property in a way that the business model will be reflected. And for property A, the market value is not important. So you need not to show the market value. So therefore you will decide to show property A at cost model, cost minus cumulative depreciation and impairment losses. So if you are to explain the concept of business model, simply what are we to say? Business model explains how an entity expects an asset to generate a cash flow to the business in the future. So that is all about it. I hope it was clear. I don't know. I wish I can get some instant feedback. If it is not clear, we can explain again, or else we can move on. Ladies and gentlemen, please give me a small quick feedback how clear it was. Simply business model is what? How an entity expects an asset to generate a cash flow to the business in the future. So property B will generate a cash flow by way of a sales, by way of the sales proceeds in the future. So might as well to show property B at fair value. And property A is to be rented and that will generate rental income. So that has got nothing to do with the market values. So better to show property A at cost model, cost minus cumulative depreciation and impairment losses. So that is business model. Second, contractual cash flows. What do you mean by contractual cash flows? Once again, a simple concept. For the cash flows to become contractual cash flows, you need to remember 3 points. What are the 3 points? Make sure the cash flows are received. Cash flows are received from the same party whom the cash flows had been originally given to. Cash flows need to include only 2 things. What are the 2 things? Capital plus interest. And cash flows cannot include anything else other than capital plus interest. Contractual terms need to specify the dates to contractual cash flows. We'll take very simple examples quickly and then to move on. If you grant a loan to a customer, say we are running a business like a bank. We are running a business like a bank and we are granting a loan to the customers. You are granting the loan to the customer. Can we collect that loan from anyone else without you collecting it from the customer whom it was given to? You cannot collect it from anyone else. You have to collect it from the same customer whom we had given the bank loan to. Second, what are we collecting from the customer? Just 2 things. What are the 2 things? It's only the capital plus interest and nothing else. Third, contractual terms specify the dates to contractual cash flows, meaning what? At the time of granting the loan, you get the customer to agree all the terms and conditions. So the bank says you need to repay the loan capital plus interest on such and such date. So both parties agree. So the customer knows when he has to pay the capital plus the loan. So what does it say? It says that the contractual terms specify the dates to contractual cash flows. As long as these 3 characteristics are included, what cash flows do we call it? We will call it contractual cash flows. If you decide to take debtors as a financial asset, again we have the same characteristics. We are collecting it from the debtor whom we sold the goods to, and you can't collect it from anyone else. Forget about factoring and so on and so forth. You are collecting only the capital, the value of goods sold, plus if the customer does not make the payment on time, we will decide to charge another interest. So the cash flows will include only capital plus interest. And nobody can decide when to settle because it's agreed once and for all. At the time of selling the goods, you notify the customer when he has to pay us, and he agrees, and then only he buys, and we get him to agree, and then only we sell. So he has to pay us, say, in 3 months' time, maybe 2 months' time, maybe 2 weeks' time. So the contractual terms specify the dates to contractual cash flows. So now let's see how these 3 items are classified into these 3. Derivatives, I can't explain the concept of derivative right now. It takes little time. It's not that important for CL2 either. Normally, we apply the business model and it has to come under fair value through profit and loss. You need to remember one thing. You classify a particular financial asset under measured at amortized cost only if it satisfies contractual cash flow characteristics. If it does not fulfill contractual cash flow characteristics, it does not come to amortized cost category. It does not come to amortized cost category if it does not include contractual cash flow characteristics, it does not come. So that part is very important. So for you to think of classifying a financial asset under amortized cost category, please ensure the fact, what is it? Please ensure that that particular financial asset fulfills contractual cash flow characteristic. Right now, equity investments. Company A makes an investment to acquire shares in company B. Investment is say 5 million rupees. Company A acquired 500,000 ordinary shares of company B at 10 rupee. So the investment made was 5 million. That investment never fulfills contractual cash flows. Why? At the time of company A making the investment, company A cannot get that investment back from company B itself. Why? For you to get your money back, whether you like or not, you must sell that investment to someone in the market. You cannot get it ever back from company B itself. For the cash flows to become contractual cash flows, you must ensure that the cash flows are received from the same party whom the cash flows had been originally given to. You gave it to company B, but you cannot get it from company B. That's not the nature. For you to get it, you must sell it to someone and recover it. So it does not fulfill the first one. Second, you must get only capital and interest in the cash flows. Is there anything called capital and is there anything called interest? When you make investments in equity shares of another company, there is nothing as such. So it does not fulfill the second requirement either. Third, contractual terms need to specify when the cash flows are received. That looks funny. When you make investments in ordinary shares of another company, company B, does company B come and tell you that company B is going to pay us on such and such date in the future? No. Company B does not tell us that company B is going to pay the capital and interest on a specific date in the future. There is nothing as such. If you make investments in ordinary shares, you will never get it back from the investee himself. You have to sell it to someone. So none of the requirements in contractual cash flows is fulfilled. So therefore, these equity shares, equity investments of other companies never come to measure that amortized cost category. Why? So for you to classify a financial asset under amortized cost category, so what is the core requirement? Ensure that will include contractual cash flow characteristics. Then it has to come only under fair value category. If it is for trading purpose, put it under fair value through profit and loss. If it is not for trading, any other purpose, maybe you acquire ordinary shares of another company for multiple purposes. Don't you? What are these multiple purposes? Maybe to acquire the control of another company. Maybe to acquire significant influence over another company. Maybe to acquire joint control of another company. Maybe to put up and develop a market monopoly. So then, if it is not for trading, you put it under fair value through OCI. So only financial instrument that has the potential of being classified under all of these is investments in debt instruments. Debt investments acquired for trading purpose, put it under fair value through profit and loss, trading purpose. Investments acquired for trading purpose, should be kept under fair value through profit and loss. Investments in debt instruments made only to collect contractual cash flows, only to collect contractual cash flows, only to collect contractual cash flows should be under measured at amortized cost. And if the business model is to collect only the contractual cash flows, the objective of the business model, so what did I explain the business model was? How the entity expects an asset to generate a cash flow to the business in the future. So the entity expects to only collect contractual cash flows from the debt investments, put it under measured at amortized cost. I'll give you one example. Say a bank is originating a loan to a customer, value is 5 million. The bank does not have any other intention but to collect the capital plus interest as it becomes due in the future. So that is contractual cash flow. The bank does not have any intention whatsoever. The only intention of the bank is to wait until it becomes due and then to collect it from the customer. So that has only what characteristics? The objective of the business model is to receive only the contractual cash flows, put it under amortized cost category. But see, you make investments in debt instruments with both objectives of collecting contractual cash flows plus sales proceeds. Contractual cash flows plus sales proceeds, and then put it under fair value through OC. So let me give you one example quickly. So we are in company A. Company A makes investments of 500 million in bonds of different banks, Sampath Bank, Commercial Bank and so on and so forth. All the bonds will mature in 5 years time from now. 5 years. What is it for? Company A thinks that if the interest rates will be up in the market, Company A will continue to hold onto investment over 5 years time until the maturity date. So that depends on how good the interest rates will be in the future. If the interest rates will be good in the future, Company A will continue to hold on to investment until maturity date. But before maturity, if the market values of the bonds will increase and the company will feel that selling these investments at the higher selling price in the market is better and you can make a bigger profit by selling it in the market because the market prices are pretty high. So the income or the profit you can make by selling investment is pretty high than the interest income you can generate by continuing to hold on to investment over 5 years. So if the market prices keep increasing, obviously Company A will sell the investments before maturity. And if the market prices will be stagnant, do not fluctuate, and they will decide to collect interest income by continuing to hold on to investment over 5 years. So they have both objectives. It does not mean that they can collect both contractual cash flows and sales proceeds. No. We can have as many objectives as we prefer to have, but only one objective can be achieved. So they have both objectives. If the market prices will be high in the market, they will sell to make a capital gain. If the market prices will be low in the future, so they will decide not to sell but to continue to hold on to investment until maturity date. Then the objective of the business model is to collect contractual cash flows plus sales proceeds. So that investment in debt instruments will be classified under fair value through OCI. I don't know how clear it was. I wish I can get an instant feedback from all of you all. Just tell me how clear it was. Hurry up. Yes. So no one is responding, will continue. Question number 3, the investment portfolio of PMD as at 31st March 2022 consists of the following financial assets. %, holding in a listed company whose share price is highly volatile. The shareholders of PMD always expect a stable earnings per share. Now the investor is PMD. They have made investments in which company? 19% holding in a listed company whose share price is highly volatile. So they make investments in a listed company. The shareholders of PMD always expect a stable earnings per share. Now what does it look like? So this is not a derivative instrument. It is not a debt investment either. This is an investment in equity shares. It never comes under amortized cost category. Why? So for you to categorize an investment under amortized cost category, it has to include contractual cash flow characteristics, and that is indispensable. So this does not include contractual. So this is a past paper question of CL2 2022. December CL2 2022 December, question number 3. So now it does not include contractual cash flows, and it does not come to measured at amortized cost. Which category should it come under then? It has to come only fair value through profit and loss, or fair value through OCI. Now you need to make a choice. Just read it, read between the lines to realize whether they acquired this investment for trading purpose. Apparently, as you read it, you will realize it for yourself that it's not for trading. So if it is not for trading, it has to come under which category? fair value through OCI. So that's what you need to say. What are the criteria we are using to classify financial assets? We are using business model and contractual cash flows. But can we use contractual cash flows for equity investments? Cannot. Then we can use only business model. So what seems to be the objective of business model? Not trading. It can be any purpose other than trading. So it does not come under fair value through profit and loss. It has to come under fair value through OCI. Second one, XYZ Private Limited. This is a strategic investment with the objective of entering into the investment advisory business and collecting dividend payment. So once again, PMD Private Limited makes investments in XYZ Private Limited. PMD is the investor, XYZ is the investee. Private Limited, shares are not listed. Is it possible for PMD to trade the shares of XYZ Private Limited? It's not possible at all. Why? You can trade only the shares of a listed company. Never can you trade the shares of a private limited. So now this investment seems to be a strategic investment, and the easiest thing here to understand where this investment has to come to is to see this word, see these names, XYZ Private Limited. You know, the shares of a private limited cannot be traded at all. This is an investment in equity. It cannot be for trading because we acquire the shares of a private limited. So if it is not for trading, which category should it come under? It has to come under fair value through OCI. So how do we explain that to the examiner? You need to explain to the examiner that this is an equity investment and we only use business model to decide how the classification should be done, and the investment is a strategic investment, so you need to make an irrevocable election to classify it under fair value through OCI. Why do we call it irrevocable elections? And the standard says the investment of equity classified under fair value through OCI cannot be subsequently shifted around. Once you classify it under fair value through OCI, that will remain under that category forever. So that will set permanently in that category. You cannot keep shifting it around subsequently. So that's a different story. We will not discuss that part here. So that has to come under fair value through OCI. Third one, 182-day treasury bills to collect interest and capital at maturity, as well as to sell treasury bills and reinvest treasury bills with higher interest. So the same example I took is included in the paper. Okay. We make investments to acquire treasury bills which mature in 182 days. So they have two objectives. What are the two? Either they are planning to continue to hold on to investment over 182 days time to collect capital and interest. And if possible, if the market prices will fluctuate, the higher the market prices, the better for the company, then they will decide to sell it. They will decide to sell it. So this entity has both objectives of holding investment until maturity date to collect contractual cash flows, as well as they decide to sell it. They decide to sell it depending on the market conditions. So this is an investment in debt instruments. And the entity has both objectives of collecting contractual cash flows and sales proceeds. So put it under which category? Fair value through OC. So how do we explain it to the examiner? You need to tell that this is an investment in debt instruments and it satisfies contractual cash flows and it satisfies the business model. It satisfies contractual cash flows. Also the business model criteria also can be used. Why? They expect to collect contractual cash flows, also they expect to collect sales proceeds. So if both characteristics can be used, okay, if both objectives are there, you then without being hesitant put it under fair value through OCI. 4th one, 91-day treasury bills to resell in the near future. 91 days, it matures almost in 3 months' time. What can you do maximum in 3 months' time? You cannot do anything but to sell. So here the examiner has been very clear. The examiner tries to indicate that PMD Private Limited purchased these investments for what purpose? For trading purpose. PMD Private Limited has purchased these investments of treasury bills which mature in 91 days for what purpose? For trading purpose. So if it is for trading purpose, so you need not to ask from anyone else, put it under which category? Fair value through profit and loss. 5th one, 3-year treasury bonds to finance the planned renovations of a building in 2025. 3-year treasury bonds to finance the planned renovations of a building in 2025. So we are planning to renovate the buildings in 2025. You need money. So the money that you think is sufficient for the future renovations would have been set aside. Without just holding that money on your hand, you have invested that in a bond. So when will you withdraw money? You will withdraw money at maturity. So you collect money at maturity. So maturity proceeds will be your contractual cash flows. So the only intention of this investment is what? To collect only contractual cash flows. So if it is to collect only contractual cash flows, you need to put it under which category? Measured at amortized cost. Measured at amortized cost. Can I have a small feedback from the students, please? Just let me know whether they were clear or you want me to explain something more. Hurry up. Tell me how clear they were, please. Ahmed, Gayani, Vidushan, Abdullah. So there is another question, I took it from SL1, once again from financial instruments. It says question number 1, Multi PLC purchased 30 million rupees 10% debentures on 1st April 2019. These debentures are redeemable on 31st March 2024 at rupees 31 million. Interest on these debentures are paid annually on 31st March each year. Multi PLC intends to hold the debentures in order to collect the interest payments and receive repayments on maturity. However, it may sell these debentures if the opportunity of buying one with a greater return arises. Effective interest rate of these debentures is 10.54%. Fair value of the debentures as of 31st March 2020 was 30.5 million rupees. As of 31st March 2021, the debentures had been impaired by rupees 300,000. Fair value of the debentures as of 31st March 2021 was 29.9 million. On 1st April 2021, Multi PLC sold the debentures at 29.9 million rupees. Required advice on the accounting treatment to be applied for the above debentures together with the calculations required up to 31st March 2021. So 10 marks have been allocated. Very easy question. If you know how the classifications are done and how you initially and subsequently measure the financial asset. Now, before everything else, you need to decide the classification. We'll decide on the classification. This is a debt investment. What seems to be the objective? See, Multi PLC intends to hold the debentures in order to collect the interest payments and receive payments on maturity. So that particular sentence says that they have the objective of collecting capital plus interest. However, there is a bit of a contradiction. However, it may sell these debentures if the opportunity of buying one with a greater return arises. And if the investor Multi PLC finds better investments in the market later, so this company Multi PLC will decide to sell this investment to buy the new investment. So they do not have just one single objective. Multi PLC has two objectives. What are the two objectives? Multi PLC has the idea to hold on to investment until maturity to collect contractual cash flows. At the same time, they have the idea to sell it halfway through or before maturity for them to finance the purchase of another new investment. So which category should it come under? It has to come under fair value through OCI. Right. Now, just to give you a small introductions on initial and subsequent measurements. Here, initial measurement is fair value. Subsequent measurement is also fair value. And fair value changes are recognized to profit and loss. And there can be sometimes transaction cost, directly attributable cost. When you make an investment, you need to incur some expenses. What examples can you think of instantaneously? It can be legal charges, it can be some taxes to the government, it can be brokerages. Those acquisition cost of investment should be in profit and loss. Don't take it to investment. Fair value through OCI. Initial measurement is fair value. Subsequent measurement is also fair value. Fair value changes are recognized to OCI. And if there is direct cost or transaction cost or the cost incurred in buying the investment, you need to add it to initial carrying value. Add it to initial carrying value. Here, initial measurement is fair value. Subsequent measurement has to be amortized cost. There you will learn some new concepts, they are amortized cost. Changes are recognized to profit and loss. Remember, that's important to remember, to calculate the amortized cost, we need to use a specific tool. What is it? We call it effective interest rate. Now, since this particular investment has to come under fair value through OCI, it has to be initially measured at fair value. It has to be subsequently measured at fair value. Fair value changes are recognized to OCI, and if any transaction cost is incurred, you need to add it to carrying value. So let me work out the calculations. We had similar questions in CL2 past papers as well, and then you can do and work out those questions alone. So this is initially measured at fair value. Fair value has to be 30 million. But I want you to understand something. Without having amortized cost calculations first, you can't complete this. In a normal theory class, this is a bit of a lengthy discussion, but we'll try to do it little fast, assuming that you have done this theory part before, no matter where you follow classes at. Okay. Let me open up a simple T account. This is just to show the amortized cost first. Investment in debentures. Investment in debentures. It is 30 million. So that's 30 million. Coupon rate given is 10%. Debentures are redeemable on 31st March 2024, that is in 5 years' time. Interest on these debentures is paid annually on 31st March each year. Multi PLC intends to hold the debentures in order to collect the interest payments and receive repayment on maturity. However, it may sell these debentures if the company of buying one with a greater return arises. Effective interest rate of these debentures is 10.54. So you recognize interest income at effective rate. So what is your effective rate? 10.54. 30 million into 10.54. Effective interest is recognized to profit and loss 3,162,000. That goes to profit and loss. the entity will keep receiving the coupon interest. Coupon interest has to be 10% and that is 3 million. 3 million. So if you close it up and take the balance, it's not fair value, it is the amortized cost. 33,162,000. 33,162,000. So balancing figure is how much? 30,162,000. So this is the amortized cost end of the first year. That is the amortized cost end of the first year. So let me continue for the second year. 30,162,000. And also let me recognize effective interest for the second year at the effective rate. You need to apply the effective rate of 10.54 on this value, 30,162,000 into 10.54, 3,179,075. So that keeps receiving coupon at 10%, that is 3 million. So we'll take the amortized cost end of the second year. This is 5, this is 7, this is 0, this is 1, 4, 3, 33 million, 341,075. So amortized cost end of the second year has to be 30,341,075. $30,341,075. This is the balance at the end of the third year. And let me complete it for the third year consecutively. 30,341,075 into 10.54. 3,197,949. And we keep receiving the coupon of 3 million. Take the amortized cost end of the third year. 33,539,024. 33,539,024 minus 3 million. This is 30,539,024. That continues over 5 years' time. That continues over 5 years' time. But this is not what the examiner is asking. Why? This has to be categorized under fair value through OCS. But without the amortized cost, you can't complete fair value. Without amortized cost, you can't complete fair value. Okay. Now, we did the investment on 1st April and we are given the fair values on 31st March 2020, 30.5. And on 31st March 2021, the debentures had been impaired by 30,000. Fair value of the debentures as of 31st March 2021 was 29.9 million. So let me re-prepare the investment account where you measure it subsequently at fair value. Say investments in debentures. Initial measurement is fair value at 30 million. We recognize effective interest to profit and loss 3,162,000. Coupon interest has to be received in cash 3 million. Now the closing balance cannot be amortized cost, it has to be fair value. So what does the question say? The fair value is end of the first year. 31st March, it is 30,500,000. So the balancing figure has to be fair value change, and that is what you need to recognize to OCI. 33,500,000, 33,500,000. This is 8, this is 3, this is 3, that should go to OCI. Balance. Now, balance at the beginning of the second year is not this value. That is the amortized cost. So we must take the fair value of 30,500,000. Effective interest will be recognized to profit and loss 3,179,075, and we keep receiving coupon at 3 million, and we'll take the closing balance. Closing balance has to be fair value. So what does the question say the closing fair value is by 31st March 2021? It is 29.9 million. 29.9 million. Let me take the change 075, 9, this is 7, this is 6, 33,679,075. See what the difference has to be. 33,679,075 minus 29,900,000 minus 3 million. It is 779,075. This is fair value change. So you recognize it to OCI. But now the question says end of the second year, of this total fair value change, 300,000 is not a fair value change, that is the impairment. So you need to credit to OCI by 300,000 and debit it to profit and loss by 300,000. You know, we normally apply credit loss model for impairment reviews under SLFRS 9. We still apply the same credit loss model, but accounting part looks little different. So that's bit of a lengthy discussion. You can't finish it in an hour or two. That takes little time to explain. Hope you've done it in your previous classes. So it's only just that we need to quickly remind of it. So the fair value change is 779,075, and you haven't taken that to OCI, then you transfer 300,000 to profit and loss as impairment charge. Only the balance will remain in OCI. OCI. Right. Now we are on 31st March 2021. What is the balance of this investment? By 1st April 21, what is the balance of the investment? 29,900,000. Now the examiner continues to say on 1st April 21, Multi PLC sold the debentures at 29.9 million. We have sold the debentures. As you sell it, you need to de-recognize it. Debit cash 29,900,000, credit it to debenture account. And what else have you got to do? If you sell that investment, the standard says cumulative fair value changes you recognize to OCI. First year you recognize how much to OCI? You recognize 338,000 to OCI in the first year. Second year you recognize 779, but 300 was pulled out as impairment. So this cumulative fair value changes you recognize to equity, cumulative fair value changes we recognize to equity should be transferred to profit. It doesn't go to profit and loss, though it has to be, I made a mistake, it has to go to profit and loss. Why? This is a debt instrument. You need to transfer this cumulative fair value change to profit and loss as you sell your investment, and that is your accounting treatment. There are logics, but with this time constraints we can't explain the logics and it takes little time. Okay. I don't know how clear it was. Those two questions are from financial instruments. If you have anything we can explain. If you have anything to ask from financial instruments, please ask it, we can explain, or else we can move on. Right. So we will see another question. It says question number 1, but it is in SL1. I mean, I have taken another small question from revenue, SLFRS 15. Why, those are the areas we normally struggle. Those are the areas where we normally struggle. So let's look at this revenue question. Okay. Communic PLC operates in the communications industry and provides a variety of services to its customers. On 1st April 18, the company entered into a 2-year contract with a customer to provide a mobile package. That includes voice and data for rupees 5,000 per month. This price represents the standalone selling price of these services. Under this package, the customer is entitled to the following facilities: a monthly data limit anytime during the day of 15 GB. Extra usage will be charged at 20 cents per MB. 1 GB is equal to 1000 MB approximately. Outgoing call limit of 1000 minutes to any network. Extra usage will be charged at 2 rupees per minute. At the time of entering the contract, the company charged 1000 rupees as connection fees for the mobile package. The customer was also given a free Wi-Fi router. Under the above contract, the company sells this type of Wi-Fi router separately as a standalone selling price of rupees 3000. During the year ended 31st March 19, the customer has used 400 extra minutes of voice and 5 GB extra of data. Required advice on the following matters based on SLFRS 15. Revenue from contracts with customers. Assume the financing component of the contract is insignificant. Whether each of the goods, services and connection fees mentioned in the contract represents a separate performance obligation. The amount to be recognized as revenue for each performance obligations for the year ended 31st March 2019, the accounting treatment for the connection fees paid. And just let me know whether you want me to explain these model in SLFRS 15, just not in so detail. I mean, it's a bit of a heavy discussions of SLFRS 15. You can't finish it in an hour. It takes weeks and weeks if you go for a detailed discussions, but just at least to add some values to your knowledge. Okay. Just let me know whether you want me to explain something quickly so that you know, then we can come to the question. Ahmad and Gayani, those who join live, please let me know. So we apply a model called control model to recognize revenue. I made a mistake. We apply a model called 5-step model in SLFRS 15 to recognize revenue. We call it 5-step model. Obviously, there cannot be 6 steps in the 5-step model. There are only 5 steps. There are only 5 steps. What are these 5 steps? First is identifying the contract. Identifying the contract. Second, identifying the performance obligations. Third, determining contract price. Fourth, allocating the contract price or transaction price over the performance obligations. Fifth one, recognizing revenue as performance obligations are satisfied. Recognizing revenue as performance obligations are satisfied. SLFRS 15 paragraph number 9 gives you some criteria to be fulfilled. For a contract to exist, you need to look at certain criteria. What are the criteria? Please make sure that the parties to the contract approve the contract. Say for a small example, company A is sending a purchase order to a supplier, we'll call it company B, to buy 10 computers just in 2 weeks' time. So company A sending the purchase order to company B is like company A inviting company B to enter into a contract. Company B does not respond. Company B does not even inform company that company B received the purchase order. So without company B approving the contract, without company B at least informing company A that company B received the purchase order, so there is no contract. So that is what paragraph number 9 of SLFRS 15 says. For a contract to exist, the parties to the contract should approve the contract. For a contract to exist, the parties to the contract should approve the contract. Okay. Then, the payment terms need to be specified. The customer has to inform the seller how the payments will be made. And there should be a probability of receiving the consideration. The transaction must have a commercial substance. I mean, you need a lot of examples to explain all the 5, but we'll quickly move on. Identifying the contract, and this is the most important step in the model, identifying the purchase order. Identifying the purchase order. Identifying the performance obligation rather. Performance obligation. Performance obligation. What do you mean by the performance obligations? So that is the hardest part in the standard. The standard says performance obligation has to be a distinct promise of goods and services. So the word distinct has to be used in explaining the performance obligations in SLFRS 50. You need to explain performance obligations using this word distinctiveness in SLFRS 15. What does it say? Does the customer benefit from the goods and services in the contract alone? Or does the customer benefit from the goods and services in the contract with the existing goods and services of the customer? Or there's another method. Is it a series of goods and services which are substantially the same with the same pattern of transfer, and then based on that you will decide performance obligations. Now let me take this example question just to explain the concept of performance obligations, and then the first step, identifying the contract. Communic PLC operates in the communication industry and provides a variety of services to its customers. On 1st April 2018, the company entered into a 2-year contract with a customer to provide mobile package. So the examiner, he himself says there is a contract. The examiner, he himself says there is a contract. There is a contract. What is it for? To provide a mobile package that includes voice and data for rupees 5,000 per month. This price represents the standalone selling price of these services. Under this package, the customer is entitled to the following facilities. Okay. Now let me take 3 items in the contract. The seller is selling a router, and the seller will be providing 2 services. They are voice and messages. So you need to keep asking questions from yourself, and this is how we identify performance obligations. does the customer benefit only from the router without the customer receiving these services from the same vendor? Yes. Why? Because the customer can buy the router from the seller. What is the name of the seller? Communic PLC. And the customer can buy these services from completely different vendor. So we have a market as such. You know these better than I do. You can buy the router from one party, say Communic PLC, you can buy it from Communic, and you can buy the other services from completely different vendor. So the customer is benefited only from the router because he can buy the other items or the other services completely from a different party, and we have a market as such. Or else the customer can buy this voice and messages from Communic PLC, and he can buy the router from completely different vendor because we have a market as such. Enough vendors are there in the market who only sells router, who only sells SIM cards. So the customer does not have a problem even if he does not buy the router from the same vendor because he can buy it from another party. So therefore, the router is considered to be distinct from the other services, and the other services are considered to be distinct from router. But these two are not considered to be distinct. They are not considered to be distinct. Why? How practical it is to take services of voice from one party and to take services of messages from another party. Now, do you know it better than I do? Are there companies which only sell SIM cards only for voice calls? Are there companies which sells only SIM cards for messages? Does a market exist as such? A market does not exist as such. There is no market as such. So therefore, you have to use the same SIM card for voice as well as for messages. You must use the same SIM card for messages as well as for voice. So these two items are not considered to be distinct. So how many performance obligations are there? There are only just two performance obligations. Only two performance obligations. So you need not to explain too much about first step because the examiner, he himself says, so there is a contract. You need not to detail as much as you try to detail it in step number 2 for step number 1 because the examiner, he himself says there is a contract, but here you need to detail little why. You need to explain to the examiner how performance obligations are identified. Determining the contract price. Now, company is charging 5,000 rupees a month, and that is for 2-year period, altogether 24 months. 5,000 into 24 months, 120,000, if I am not mistaken, 123,000. So this company is selling two items, router and services, just for a common consideration of how much? 120,000. And not that can this company recognize this 120,000 as one item revenue into profit and loss. This 120,000 need to be broken down into two. What are the two? Out of 120,000, you need to allocate some amount to the router. Out of 120,000, you need to allocate some amount to the services. How do we do that? We can use three methods as given by SLFRS 50. We can take cost adjusted market, adjusted market value. So we can take markup, cost plus markup, or we can take residual value. And it's a bit of a lengthy discussion, so we can't explain everything in a single question. Then we can allocate the contract price over the performance obligation. How do we do that? If a customer buys the router in a separate standalone transaction, what price has the customer got to pay? It is 3,000. 3,000. And in a separate standalone service transaction, how much has the customer got to pay for the services? 120,000. Now this customer receives router and the services for a common consideration of 120,000, which the customer has to normally purchase at 123,000 in separate standalone transaction. So based on this standalone prices in separate standalone transaction, based on the prices of separate standalone transaction, this 120 has to be now allocated, has to be broken down. Okay. So now coming back from the beginning, how do we apply 5-step model for this question? There is a contract to sell the router and to provide services over 2 years. That is by applying paragraph number 9 of SLFRS 50. Identifying the performance obligations. Identifying the performance obligations. We identified 2 performance obligations. What were the 2? Sale of the router and the sale of the services. Router and the services are distinct from each other. And what is the contract price? Determining the contract price, just a simple exercise. The seller is selling these 2 for a common consideration of 120,000. Fourth one, allocating the contract price over the performance obligation. So that is what we are using this standalone prices for. So we'll do it now. Transaction price. Transaction price for the router. For the router. 120,000 divided by 123 into 120,000. So this is what we are commonly collecting for these 2 transactions of selling router and the services. Now how much out of 120,000, how much are we going to allocate for the sale of router? Then transaction price for the services. It is 3,000 divided by 123,000 into 120,000. We'll work it out. 120,000 divided by 123 into 120,000. So we need to allocate 117,073 to the, I made a mistake, this is for the services and this is for the router. For the services, how much do we allocate? 117,073. And to the router, how much do we allocate? 3,000 divided by 123 into 120,000. It is 2,927. 2927. 2927. 2927. Right. So we have gone through 4 steps by now. What are the 4 steps? Identifying the contract was done. Identifying performance obligations were done. Determining the contract price was done. Allocating the contract price over the performance obligations were done. So we are now at the last step, recognizing revenue as performance obligations are satisfied. Okay. Now SLFRS 15 says performance obligations are satisfied in 2 ways. What are the 2 ways? Performance obligations may be satisfied at one point in time, or performance obligations may be satisfied over a period. If you have the standard book, you can refer to paragraph number 35 of SLFRS 50. So that says, need to look at 3 criteria, A, B, C. There are 3 criteria to see, to decide whether the performance obligations are satisfied over a period. If the performance obligations are not satisfied over a period, and then only you need to decide that the performance obligations are satisfied at one point in time, and again the standard has given you criteria to identify what that specific point in time is. So I will not explain all of them right now, but let me apply them to the question. Router. What is the performance obligation of the router? In simple terms, that is the sale of the router. So at which point does the sale of the router transaction happen? When the control of the router passes to the customer. When the physical possession of the router passes to the customer. When the risks and rewards of the router passes to the customer. When the customer becomes liable for the payment. So all of them happen at the same time. So normally the sale of the router occurs when the physical possession passes, when the legal title passes, when the risks and rewards pass to the customer. So that is very simple exercise, you know. So that is the time at which the seller gives the router to the customer. So that point only he has to recognize revenue. So that happens immediately. So this revenue 2927 can be recognized to revenue immediately. That revenue of 2927 can be recognized to revenue immediately. Okay. And what about revenue attributable to services? Revenue attributable to services should be recognized not at one point in time. It has to be over a period. Why? Paragraph number 35. So that has given 3 criteria. What are the 3 criteria? So there is one criteria. It says, if the services that the service provider are consumed by the customer simultaneously, if the customer consumes the services provided by the service provider simultaneously, then the services are considered to be provided over a period. Now if you sit in a physical class with 100% interactions face to face, the teacher teaches and then you are seated in front of the teacher, So this is kind of not a virtual classroom environment, and this is like what we used to have sometimes back. Okay, with kind of interactive session. He teaches and the students can listen, and if the students have some concerns, they can raise the questions. That is how it goes. Now, in a physical sessions or even in a live class, right at the time of the teacher teaches, the students will consume the lessons simultaneously. So there is no time gap between the time of the teacher teaching and the time of the students learning. There is no time gap. The students will learn the subject and the topic right at the time of the teacher teaching. The teacher teaches, in other words, he provides the services, simultaneously the customer will consume the service. Then the services are considered to be provided over a period. Take a janitorial company, they provide cleaning services. So the cleaning company will provide the services, at the same time the customer will consume the services. So there is no time gap between the cleaning company providing the services and the customer consuming the services, no time gap. But say, in recorded videos like Infinity, there's a time gap. We will first keep it taught to a device, camera, and we will keep it stored in the platform, and you will learn it later. So that's not what I'm talking about. In a class like this, I teach and you learn, same time, no time gap. Then the services are considered to be provided over a period. So likewise, the services are considered to be provided over a period. The revenue attributable for the services need to be recognized over a 2-year period. The services attributable to services, revenue attributable to services should be recognized over 2 years. If you recognize revenue over a period, how do we slice it over 2-year period? How do we recognize? You can use 2 methods, input method, output method. Input method, output method. Okay. The examples have been given in the standard for input method, and the standard has given examples for output method as well. Now here, the best method has to be what? Time period. Time period. Time period. So now, out of 117,073, the revenue for the first year should be how much? You need to divide it by 24, and if 12 months have gone, you can recognize the revenue attributable for the first year. So that is how it works. Revenue attributable to the router can be recognized immediately, and the revenue attributable to services should be recognized over 2 years. Which method are we using to recognize revenue? Time period, and how many months have gone? 12 months have gone in the first year, so you need to recognize revenue by dividing it by 24 and multiplying it by 12. Okay. Now, they ask another question. The accounting treatment for the connection fees paid. It's a bit of a contentious area in the standard. Now we have similar examples. Say we'll think of a private university. And they are providing degree programs. The value of a degree program is like 1.5 million rupees. A student will get registered himself at the university and he pays only just 50,000 registration fees. Just because he only pays the registration fees and without paying the others, does he have the right to walk into the lecture halls and to get lectures? He does not have the right. Just because he only pays the enrollment fee, he does not have the right to receive the services. And just because he pays only just at the payment of the registration fees, he does not have the right to receive the services. At the same time, the university is not under the obligations to provide the services. So for this 50,000 enrollment fees, there is no specific performance obligations identified in particular. There is no performance obligations identified in particular for that enrollment fees, and this connection fee is almost similar to that enrollment fees of a university. It's almost similar to enrollment fee of university. What is the connection fee? Connection fee is rupees 3,000. How much is it? ₹1,000, and that 1,000 has to be recognized over a 2-year period. That 1,000 rupee connection fees has to be recognized over a 2-year period. So apart from that, there are extra charges. What are the extra charges? Extra charges are the customer has used extra minutes 400 during the year. Now the revenue for the first year, let me show you the revenue in total clearly. Revenue, sale of router, $2,927. Services, 117,073 divided by 2, 58,537. Connection fees, connection fees 3,000 divided by 2 into 1, 1,500. Then extra usage, they have used 400 extra minutes. 400 extra minutes into 2 rupee per minute, 800. And data, extra data was how much? 5 GB of extra data. 5 GB, that is 5,000 MBs. What is the charge per extra MB? 20 cents. It is 1,000. So this is going to be the total revenue for the company for the year ending whatever the date. Okay. So that was a question from SLFR is 9. we'll get back to CL2 questions, and that is once again from financial instruments and earnings per share. Sun PLC is an entity listed on the Colombo Stock Exchange. Its financial year begins on 1st April and ends on 31st March of the subsequent calendar year. The following information is available in relation to Sun. Sun issued 200,000 number of convertible bonds with a 5-year term on 1st April 2020. The face value of the bond was 1,000 rupees and the company issued bonds at a 2% discount on the face value. Question is from financial instruments, but it's not from financial instruments and EPS. It's from financial instruments, but it's from, say, compound instrument. Compound instruments. You know, a compound instrument is an instrument that includes two elements. It is including equity and it is including liabilities as well. It is including equity element as well as liability element. Equity plus liability. When you prepare financial statements, you wouldn't have ever experienced of equity and liability being shown together. No, that's not the practice ever. We always must have the practice to show them separate. That is why we show equity and separately, because they have different characteristics, different economic characteristics. You must not ever have the practice of showing them together. So compound instrument is an instrument where equity and liability components are dwelling and existing together. They are existing together. They are coexisting together. So it's not apparent at a glance. Only the people like you who know financial instruments know that it is including two components. So now LKS 32 requires us to apply split accounting to separate out liability component from equity component. So that is what is tested in this question, and though it is a CL2 question, it is bit of a heavy one. Why? That is also including transaction cost. So let me just go through. It says Sun issued 200,000 number of convertible bonds with a 5-year term. On 1st April 2020, the face value of the bond was 1,000 and the company issued bonds at a 20% discount on the face value. The associated cost related to the bond issue was 2.5. The bond carry a coupon interest of 7.5, payable annually on 31st March of each year. On 31st March 2025, the bonds are convertible for 4 million shares at 55 rupees each. On the bond holder or the bond holders can request the settlement in cash at a 10% premium on the face value. The effective interest rate associated with the financial instrument with a similar characteristic except the convertible option is 12%. Sun expects all the bond holders to convert the bonds to shares at maturity. Right, now what do? You need to take the future cash flows and discount it at the market rate of 12% in order to first find the fair value of liability, and let me do that part. Let me take the years and let me take the cash flows and let me take the present values. So that matures in 5 years time. So let me take first year end, second year end, third year end, fourth year end and the fifth year end. So that is 200,000 convertible bonds with a face value of 1,000. That is 200 million altogether, but let me put the figures in thousand. 200,000 into 1,000, it is altogether 200 million. 200 million into the percentage is how much? Coupon has to be 7.5. So 200,000 into 7.5% is 15,000. So the company has to keep paying 15,000 coupon at the end of each year. And at the end, the investors can receive the face value plus coupon plus 10% premium. How much is it? Face value is 200,000 and premium has to be 10%. 10% on face value is 20. and the last year coupon has to be 15, altogether 235,000. 235. So you need to keep discounting them at market rate of interest. That's given. How much does it say the market rate is? 12%. So this is by 1.12, 1.12 to the power 2, 1.12 to the power 3, 1.12 to the power 4, 1.12 to the power 5. We'll work it out. 15,000 by 1.12. 13,393. This is 11,958. This is 10,677. 677. This is 9,532. 133,345. That is 178,905. Proceeds from the bond. Proceeds from the bond. We issue it at a discount. 200,000 is the face value, but we don't receive face value. We receive at a discount of what? Discount has been 2%. That is into 98%. 196,000. So the equity component should be how much? Equity component 196 minus 178,905. 17,095 should be equity component. Now, the transaction cost has to be divided between equity component and liability component. Total value 196,000. Equity component 178,905, liability component 178,905, equity component 17,095. So there is a transaction cost. What is the transaction cost? Transaction cost is given. Transaction cost is 2.5. This 2.5 should be divided proportionately between equity and liability component. Proportionately. So let me divide 2,500 by 196,000 into 178,905. We are deducting 2,282 from liability. And 218 should be deducted from equity. This is 3, this is 2, this is 6, this is 6, 176, 673, this is 7, 7, this is 8, this is 16. So ultimately, you credit it to liability by 176, 623, and you credit it to equity by how much? You credit it to equity by 16,877. 16,877. For this liability, you need to apply amortized cost. To apply amortized cost for the liability, you need to have effective interest rate. Now this given 12% market rate cannot be used as effective rate. You need to work out the new effective rate. So what should be the new effective rate? The new effective rate has to be IRR. You need to work out the simple IRR calculations to find out what IRR has to be. Year 0, first year end, second year end, third year end, fourth year end, and the fifth year end. And how much cash flows are we receiving at the beginning? Year 0, 176, 623. And how much to be paid annually? 15,000 should be paid here, 15 to be paid here, 15 to be paid here, 15 to be paid here. Finally, you need to pay 235,000. So let me put the figures into a formula to work out IRR. 15,000 divided by 1 plus R. 15,000 divided by 1 plus R squared. 15,000 divided by 1 plus R to the power 3. 15,000 divided by 1 plus R to the power 4. 235,000 divided by 1 plus R to the power 5 minus 176,623 should be equal to 0. If you solve this using the calculator, you can simply find out IRR. I don't know whether you all know how to do it, and let me solve it quickly. IRR has to be 12.33. That is the effective interest rate. So let me only show you the first year accounting. 176,623 into 12.33 will recognize the first year interest 21,777. And let's pay the first year coupon in cash 15,000. So you can close up liability account 0, this is 0, this is 4, this is 8, this is 9, 1, 198,400. So the amortized cost of liability under the first year has to be 183,400. So I was trying to explain certain areas of financial instrument and SLFRS 15 just to add some values to your knowledge. Hope it was, I don't know how clear it was. So let me wind up our discussions with this now. And I must again extend my heartfelt gratitude for Infinity and Big Four Facebook page for organizing this, just to share some knowledge with you all guys. You must be sitting for the coming exam in December 21. Hope it will be you will be able to pass it with above the optimistic levels of expectations. All the very best guys for the exam, and thanks for joining, and we will meet up again one fine day in the future. Thank you.